This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the second lecture, working through chapter 13 of the free lecture notes for paper P2. And I said in the previous lecture, where we'd looked at relevant cash flows, I said there were three specific problems that tend to arise with full net present value questions, which are working capital, tax and inflation. So let's build it up gradually. Let's look first of all at working capital, what it is and how it affects us. And I'll say I'll have to build it up gradually, introduce tax and inflation separately. But to explain the relevance of working capital and how we deal with it, can you look straight to exercise 2 in chapter 13 and have a read with me. It says a machine costs 100,000 to purchase. In addition, a further 20,000 working capital will be required at the start of the project. The machine is expected to last 4 years and have a scrap value of 20,000 at the end of its useful life. The net operating cash flows are expected to be 30,000 a year for the first 2 years and 40,000 for the following 2 years. And all operating flows are assumed to occur at the ends of years. It says calculate the net cash flow for each of the years in question. And for this one again, we're not required here to discount. In the exam we will be discounting, in the later ones we will, but you already know the mechanics of discounting. But before we can even discount, we need to know what the net cash flow is in each of the years. Now, how you set out your answer in this sort of exercise is up to you, your workings. But standardly, it's neat to set it up in columns. That are naught is now, time 1 is in 1 year's time, 2 years' time, 3 years' time, and so on. Well, it says this project lasts 4 years. And so I'm going to do columns, whether it's a cash flow now or it's in 1 year's time, 2 years' time, etc. And what does it say? It says a machine costs 100,000 to purchase. And so fine, the initial cost, we always assume, unless you were told differently, that's payable immediately times 0 now. And so there's a cash outflow of 100,000. Leave working capital for a moment. I'm going to explain that separately. So jumping over that, it says the project will last 4 years and have a scrap value at the end of 20,000 at the end of its useful life. So there's a cash receipt. There's expected scrap value. In 4 years' time, we expect to receive 20,000, a cash inflow. The net operating cash flows. Well, operating cash flows essentially is your profit, but in cash terms. So it's your cash revenue less your cash expenses. And we're told here we've got an operating cash flow um, 30,000 a year for the first 2 years, 40,000 for the following 2 years, and it does say below, and this is the normal assumption, that all operating flows occur at the ends of each year. So time 1 is 1 year from now, time 2 is 2 years from now, and so on. Well, if we get 30,000 in the first year, and if we receive it at the end of the year, there's an inflow of 30,000 in 1 year's time, 30,000 in 2 years' time, 40,000 in 3 years, 40,000 in 4 years. So no problem, a nice simple example. We're listing all the cash flows each year. Finally, though, the working capital. If you go back to the beginning, it says a machine costs 100,000 to purchase. We put that in, fine, a cash outflow. In addition, we'll need a further 20,000 working capital. And working capital is money we'll need to, for example, purchase inventory. You know, we'll need to buy materials and things to produce whatever we're producing. To finance extra receivables if we're selling the goods on credit. So it's that sort of thing, inventories, receivables. But if we need this extra working capital of 20,000, then at time 0 now, not only do we need to pay out 100,000 to buy the machine, we need to pay out 20,000 to buy our inventories of materials, etc. However, we always assume, unless obviously you're told differently, that although we'll need to hold extra inventory, 20,000, while the machine is operating, we always assume that at the end of its life, we no longer need that extra material, the extra financed extra receivables and so on. And so automatically, unless, as I say, you're told otherwise, obviously, automatically we assume that that 20,000 is only needed for the life of the project, and that automatically we get it back, an inflow at the end of the 4 years. As working capital itself, terribly easy. Always with the investment needed at the beginning, but always, unless, as I keep saying with everything, unless you're told differently, but otherwise always, we assume at the end of the life we get that 20,000 back. And so what's the net cash flow each year? At time 0, a total outflow of 120,000. At time 1, an inflow of 30. At time 2, an inflow of 30. At time 3, an inflow of 40. And at time 4, a total cash inflow of 80,000. And there we are. Now, in later exercises and in the exam, we would carry on and discount it. If the cost of capital was 10%, we know how to discount from the previous chapter. We'll multiply by the discount factors for 1 year, 2 year, 3 year, 4 year, and work out the net present value. And we'll do that with the later ones, but not with this one. This one was just to illustrate how we deal with working capital when it's mentioned in the question. Okay? All right, let's do one more in this lecture. Deal with one more problem, which is tax. You see, look at that one in front of us. We've got a net operating cash flow in the first year of 30,000. Well, of course, in real life, if you're earning 30,000, there will be tax payable on it. And tax, of course, is a cash flow. I earn 30. If I then have to pay tax on it, then there's going to be an outflow of whatever the tax is. So, we do need to be able to deal with it. And this isn't a tax exam as such. And so, no big complications. If you know anything about tax, you'll know that, the tax on the profits, we have to adjust the profit for all sorts of things. Allowable, unallowable. None of that. We assume tax is payable on the profits, and you'll be given the tax rate. But one extra little complication is, although you have to pay tax on your profits, you should be aware that the capital expenditure will entitle us to capital allowances or tax allowable depreciation. And so the actual tax payable will be on the profits less these capital allowances. And before we look at exercise 3, where I go through it, Although there are two ways you could actually arrive at this. For discounted cash flow questions, the way I'm going to show you is by far the easiest. Just suppose, a tiny little example, suppose we made operating cash flow of 100 in 1 year. Operating cash flow 100. Now remember, the cash flow is the profits in cash terms. And although I know there are lots of reasons why the cash profit will be different from the accounting profit, the only one we really think of is depreciation. That the accounting profit would have charged depreciation. The cash profit, that effectively is the profit before depreciation. Now again, you should be aware that for tax purposes, they take the profit before accounting depreciation and they subtract capital allowances. They subtract tax rules depreciation and then they work out the tax. So suppose I tell you the capital allowances this year, I'm making up figures just to explain the principle. Suppose I tell you the capital allowances are 20. That would mean the taxable profits were 80. And it's on that figure that they'd actually calculate tax. And again, I'm making up a figure. Suppose tax is 30%. The tax would be 24. No problem. But what would actual cash flow be? The actual cash flow, the 20 isn't a cash flow. It was only there to calculate what the tax payable was. The actual cash flows is the operating flow of 100. And although we've had to do our little tax computation, the tax, we'd have to pay out 24. So the net flow would be 76. I hope that's making sense. Now, by all means, you could do your workings that way. But what's more efficient and easier in the exam is to do it this way. Is to say, the operating cash flow is 100. No problem. We then say, what would the tax be if there were no capital allowances, if there was no tax depreciation? The tax at 30% would be 30. However, we know we're not going to pay tax. Why not? Because they actually tax us on the taxable profit. And why is it going to be lower? We're going to save tax on the capital allowances. And so tax saving on capital allowances. Well, if the capital allowances were 20, well, you'll save tax at 30% on the 20. You'll save 6. And so again, what's the net cash flow? 100 less 30 is 70, plus 6 is 76. You get the same result either way. And I said earlier, it doesn't matter which way you do it in the exam, but by far the most efficient, the safest, the quickest, the easiest is to do it that way, as I'm about to do in a somewhat bigger example. So we'll take the cash operating flow, we'll work out the tax on it, and then separately we'll bring in the tax saving on the allowances. All right, well, having I hope made sense of it, we can then become rather automatic. So look at example 3 with me. A company has a year end of 31st December each year. They're considering buying a new machine on the 1st of January 2003 at a cost of 10,000. I've kept this very short. It says we expect net operating flows of 5,000 during the first year and 7,000 during the second. And we're going to sell the machine at the end of the second year for 6,000. So it's a very short one. It only lasts 2 years. So I've set up columns as I did in the earlier example. More likely 3 or 4 years, but I wanted to keep this short. And let's work through. First of all, let's write down the operating cash flows and watch the order I do it in. The operating cash flows, third sentence, it's expected to generate net operating cash flows of 5,000 in the first year, 7,000 in the second. Easy. Just like I tried to explain a few minutes ago, we then write down the tax on the operating cash flows. So for the minute, ignore capital allowances completely. If there were no capital allowances, we'd pay tax directly on the 5 and the 7. You'll be given the tax rate, and if you look 3 lines from the end, it says corporation tax, company tax is 30%. So the tax on 5,000, 30% of 5,000 will be 1,500. However, always read carefully. Here on the same line, it says tax is 30%. It's payable 1 year in arrears. Now, this always in exams say one of two things. They either say it's payable immediately, or there's a 1 year delay. Now, the tax itself, 30% of 5,000 is 1,500. If the question had said it was payable immediately, at time 1 you receive 5,000 and you'd pay 1,500. But here it says we pay it 1 year late, 1 year in arrears. And so the tax on the 5,000 will be payable in 2 years' time. And similarly, the tax on the 7,000, 30% is 2,100. It's payable 1 year in arrears, and therefore time 3. So far, I hope easy enough. But just read carefully, as I've said. Obviously, check what the tax rate actually is. 30%. It could be anything. But just as importantly, does it say tax is payable immediately, or does it say it's 1 year later? Next, look at the capital flows. And by the capital flows, the original cost. Now the cost here, second line of the question is 10,000. That's payable immediately. And then is scrap proceeds. Are there any? Yes, 4 or 5 lines from the top. We intend to sell the machine at the end of the second year for 6,000. So in 2 years' time, a cash inflow of 6,000. However, and here's the bit where we need a bit of workings. It says 2 lines from the bottom, capital allowances are available at 25% on a reducing balance basis. Now again, this isn't a tax exam, so you're not expected to know capital allowance rules. You'll be told, it says here 25% reducing balance. But if you think back to that little tiny example I did a few minutes ago, if there are capital allowances, we'll end up saving tax as a result. The tax saving on the capital allowances. Now watch me carefully here. I'll have to show separate workings, so I'll wind down a bit and then we'll come back and finish off the table. So the workings for the capital allowances. The way it works, we've got the original cost of, what was it, 10,000? The capital allowances, it says 25% reducing balance. So the first capital allowance, 25% of 10,000 is 2,500, leaving a tax written down value of 7,500. Now you should know how reducing balance works. You know, next year 25% of 7.5 and so on. But before we go any further, three things. One is, remember, what I'm after is the tax saving we'll make as a result. So if the capital allowances are 2,500, well, with tax at 30%, the tax saving that will result is 750. So there is the cash flow that we're going to bring into our table, the tax saved as a result. The second, now watch this carefully, but I will give you a rule in a minute. The second thing to consider is, when will we get that saving? Will it be at time 0? Will it be at time 1? Will it be at time 2? And so on. Well, think about this. It says that we're buying the machine on the 1st of January. Our year end is 31st December. And so the actual calculation of capital allowances will be at the 31st December, at the end of the first year, and it'll be deducted from the cash profit for the first year. So it'll actually be calculated at the end of the first year, time 1. But because there's a 1-year delay in tax, we'll actually get the benefit 1 year after that. So it's taking them 1 year before they actually calculate it. Another year, because of the 1-year delay, will make the saving, therefore, at time 2. Now, if I did say that too fast and confused anybody, in fact, it doesn't present a problem really in the exam, because appreciate, the first tax payable on the first year's profits was at time 2. Capital allowances in real life reduce the first year's profits. The benefit would also be at time 2 as well. So there's a benefit of 750 at time 2. Finally, before we continue, think how many years we're going to be doing computations for. You know, we do a computation for every year we own the machine. And so normally you'd carry on and say, oh, in the second year, it'd be 25% of 7,500. In the third year, 25% of reducing balance, and so on. But the one extra rule you need is what happens in the final year, the year in which you sell it. Now again, I kept this one very, very short. Next example will make it a bit longer. But this machine we only have for 2 years. And so we'll have a computation for each of 2 years. The first year, I hope I've already made sense of. But here, the second year is the last. And the rule is, this is one tax rule that you do need for the exam. The rule is that in the final year, the year you sell it, you don't get 25%. You get all the remaining allowances. All we do is subtract from the tax written down value, subtract the scrap proceeds, which in this case, what are they? We're going to sell at the end of the second year for 6,000. And whatever's left is here what we call a balancing allowance. Now, just to make sense of it, if it helps, but a rule's a rule, the point is, the tax people say over the entire life, you know, it costs you 10, you sell it for 6, and so, in a sense, the net cost, pay out 10, get back 6, the net cost of 4, you're entitled to 4,000 allowances in total. It's 25% reducing balance every year, but the last year, you get whatever's left over. And so the allowance in the final year will be 1,500. Again, the saving is 30% of it, which is 450. And it'll be 1 year later, it'll be times 3. Now, I'll finish off the table in a moment, but just to cover everything, had there been no scrap proceeds, rule stays the same. If there's no scrap proceeds, you'd subtract 0, and therefore the balancing allowance would be 7,500. No problem. Or what happens if the scrap proceeds have been 8,000? Well, if the scrap proceeds have been 8,000, you've had too many allowances. The difference, 7,500 and 8,000, is 500. Well, this would be what we call a balancing charge. And so instead of saving tax, there'd be extra tax payable at 30%, 150. So it's the same rule, but if you sell it for less than tax written down value, you get an allowance, save tax. If you sell it for more than written down value, there's a charge, you pay more tax. Anyway, now we can finish it off. It was 750 saving at time 2, 450 saving at time 3. Lovely. Anything else? Oh, one thing I've jumped over deliberately. It says additional working capital of 1,000 will be required at the start of the project. Well, one extra, I think, fairly common sense rule about working capital is that because it relates to things like having to hold extra inventories, we always assume there is no tax effect. So you always leave working capital to the very end. And what does it say? It says we need 1,000 at the start, so times 0. And I did say earlier in the previous exercise that we assume always, unless you're told different, that the working capital you get back at the end of the project. So an outflow times 0, it lasts 2 years. An inflow of 1,000 2 years' time. But always leave that till the end. Working capital has no tax effect. Now we've got the net cash flow each year. So at times 0, an outflow of 11,000 at time 1, an inflow of 5,000. At time 2, 7, 30, I'm going to use my calculator. 7,000 minus 1,500 plus 6,000 plus 750 plus 1,000. I think an inflow of a net inflow of 13,250. And finally at time 3, a net outflow of 1650. This time we will discount, but we spent enough time on this in the last chapter, so this should be a formality. But to discount, it says the cost of capital is 10%, so we'll multiply by the discount factors at 10%, which for 1 year, let me find my tables, make sure you get the right tables incidentally. These are individual flows, so use the ordinary present value table. 1 year 10% 0.909, 2 years 0.826, 3 years 0.751. And so the present values 5,000 times 0.909 is 4545. 13,250 times 0.826, 10945. Don't work in cents, for heaven's sake. And finally 1650 times 0.751, 1239. But remember that is negative. And so what's the net present value? Oh, just left enough space. The positives 4545 plus 10945 minus 1239 minus 11,000. I get plus 3251. And of course, the fact that it's positive means that we would accept the project. Had the answer been negative, the conclusion would be that we'd reject the project. So that's made it a bit more interesting. Working capital, appreciate, very easy. Just remember there's no tax effect. The tax itself, I think, very easy on the operating flows. But I'm afraid there is that business about the capital allowances, so make sure you've got it. Anyway, we've one more problem to turn it into a really full question, which is dealing with inflation. So one more lecture when I'll go through a full example with everything in it.